What if the money you borrowed just to survive could be turned into the capital that helps you thrive? That's today's episode, and that's what it's all about. Moving your business from high cost debt into smart, sustainable capital. Welcome back to the Heartbeat of Money. I'm Jon P. Moffitt, and in this episode 4 of the Business Reset Blueprint series. So let's quickly review what we've been through. In episode 1, we broke down the cost of money and the massive gap between loans at 6% versus loans at 40%. In episode 2, we uncovered the warning signs of debt traps, the moment when debt starts controlling you instead of fueling you. And in episode 3, we introduced the reset. The reset strategy where you audit, restructure, reset, and rebuild. And now, in episode 4, it's time to ask the big question. How do I actually move from high-cost money into smart capital? I want you to think about money in 2 categories. Desperate money, which is merchant credit advances, stacked credit cards, payday or hard money loans. It usually comes with a daily withdrawal, sky-high interest rates, and very short term. Desperate money drains you. It doesn't give you room to breathe, it suffocates. Now, strategic money, SBA 7A or 504 loans, traditional bank term loans, business lines of credit, equipment financing at reasonable terms. Strategic money is structured, affordable, and designed to fuel growth. The difference between desperate and strategic money, desperate money keeps you alive, but at a cost that will eventually crush you. Strategic money fuels you. It multiplies what you've already been building. So how do you actually move from one side to the other? Here's 4 pathways to consider. 1, consolidation. Take multiple high-interest loans and roll them into a single low-interest product. For example, 3 merchant cash advances at 28% can be consolidated into an SBA loan at 9%. The payments don't just drop, they become predictable and manageable. 2, refinance. Replace short-term high-cost debt with long-term structured financing, moving from hard money lending at 20% to a commercial bank loan at 8%. Same principal amount, but a radically different impact on cash flow. Number 3, accessing lines of credit. Instead of leaning on a 25% credit card, move towards revolving business lines at single-digit rates. Lines of credit gives you flexibility without draining your cash flow. They're like an umbrella. You may not need them every single day, but when the storm comes, they keep you covered. And number 4, asset-backed lending. Use what you already know and already own. Equipment, property, receivables to secure your financing. When you collateralize, you lower the risk for the lender, and that usually means lower rates for you. Think of it this way. Your assets can be more than just tools and production. They can be leverage points for smarter capital. Let me break this down with a story. I work with a client in the construction industry. He had 2 merchant cash advances and 3 maxed out credit cards. His effective interest rate was over 30%. Every week, his cash flow got tighter. And every week, he felt more pressure just to keep projects going. So we stepped in and consolidated all into a single SBA loan at 8.5%. His payments dropped by nearly 60%. And suddenly, instead of chasing debt, he had freed up cash to invest. He used the cash flow to hire a project manager, which allowed him to take on bigger contracts. And those contracts expanded his revenue base. That's the domino effect of moving from desperate money to smart money. And it doesn't just lower stress, it creates opportunity. Now, let's layer in some context. Why is this shift so important right now? Because we're in one of the tightest credits environments we've ever seen in decades. Rates are elevated. Even with talks of cuts, the Fed's remains at the highest in 20 years. Borrowing is just simply more expensive, and banks are cautious. After volatility in the regional banks, credit standards are stickier. Small businesses are the first to feel the pinch. Costs are sticky, inflation has cooled from its peak, but it hasn't gone down. Food, fuel, and wages are still higher than they were pre-pandemic. That means more business owners have been pushed towards desperate money. But, and here's the opportunity, banks, credit unions, and SBA lenders, they're still lending. The key is how to present yourself. If you're lender ready with organized financials, a clear business plan, and debt structured, you'll be far more attractive to smart money sources. And that's the reset, and that's what it's all about. This isn't just about numbers, it's about positioning your business for the future. When you move from high cost to smart capital, you step into capital readiness, where you become bankable, lender friendly, position yourself to access funds and opportunity strikes, creating opportunity excellence with free up capital and cash flow that you can reinvest into system, processes, and people. And being focused on due diligence, you can evaluate the opportunities from a place of strength instead of a place of desperation. This is how you set your business up not just to survive, but to scale. Now, I know some of you may be thinking, Jon, this sounds great in theory, but my situation feels impossible. Well, let me speak directly to that. Every business owner I've worked with who's been drowning in desperate money felt the same way at first. And every one of them thought that they were the only one. But you're not alone. This is happening everywhere: restaurants, construction, retail, service businesses. And if others can restructure, reset, and rebuild, so can you. The key is courage. The courage to face the numbers, the courage to stop stacking loans, and the courage to step into smart capital. So here's the takeaway. High cost money might keep your business alive short term, but long term, it'll crush you. Smart capital isn't just cheaper, it's the fuel that lets you grow. And the good news, you can make that shift. You can reset. You can restructure. And if you're ready to explore how, I built a resource just for you. It's called the Next Age Wealth Legacy Builder Journey. And it's designed to walk you through the process step by step. Check it out at nextagewealth.com. And make sure to join me in our next episode, where we'll go deeper into the hidden opportunities that open up once you reset. Because restructuring debt isn't just about survival, it's about positioning yourself to capture growth and even acquisitions. So until then, I'm Jon P. Moffitt, and this is the Heartbeat of Money, and we'll see you next time.